our guest investor today, because he's been in tech sales for the majority of his career, coming to us here out of Boston, Massachusetts, Kevin O'Brien. Welcome to the show, Kevin.
Yeah, thank you. Great to be here. Appreciate it.
It's good to have you on. Can you tell us a little bit about your investing journey?
As you mentioned, I started out in tech sales. I'm still in tech sales, but I'll call it in the latter phases of tech sales. And I don't know, a couple of years back in 2020, I started to say, hey, this working towards a magic number, which I could never actually fully define. I had to go figure out something about this whole cash flow thing. And Greg, my understanding is you're one of the first Fortune Builder students. I came to you guys through Fortune Builders. So I signed up with Fortune Builders, went to them, talked about cash flow. They did the right thing at the time, and they put me in a pure cash flow community, which turned out to be Kansas City. Bought a few properties there, but I kind of learned pretty quickly. I should have been clearer with them that for me, I found out cash flow is not the only thing. I've listened to your show a lot, and I've also realized the cash flow isn't that much different, but the property appreciation, the rental appreciation, and all that in other markets are different. So I bought my next 4 properties with you guys. It's been a great experience, and hope to be continuing it.
Kevin, that is just so amazing to hear about your journey. And, when we started the show 3 years ago, not a lot of people thought like you. And we didn't hear a lot of stories like that, but I think we're hearing these stories more and more. What can you say? What was that trigger moment for you where you started to think beyond just cash flow? What really spoke to you?
Well, I happened to start investing right during COVID when real estate prices were going through the roof. I actually happened to buy a property here in the Boston area for my daughter that she rented. And I started to see the appreciation side pretty darn quickly. And my kids are involved in the rental thing. I saw the rental thing, appreciation thing, and I'm just like, kind of made sense. So when I went my next one, I said, let's try it. Diversification was big. So I said, move to an appreciation market, and I think I'll stay.
Love that.
All right. So Kevin, it's just incredible to see this journey for you. So what we did is put together some highlights of your journey. We're going to show the full picture of it. We're not only going to show just the best things that have happened to you in your portfolio. We're going to show the full picture, which is what we do every single time we get to have a client like yourself on here. So Kevin, this is what you've built out with the client service team and our sales team as you go through the process of onboarding as a new client. We always want to understand why. And for you, diversification, retirement, leaving a legacy, supplemental income, all the things that you talked about on the show so far today are really the things that drove your decision to come to this asset class. You built a monthly passive income goal of $8,000. We break that down. That would require a total of 8 properties in order to accomplish that. You're at 4, which is incredible. So congratulations. And it looks like your year to achieve that current milestone is 2026. And considering another purchase here sometime in the April timeframe. So wonderful start to the portfolio. And this is exactly what those 4 properties are in your portfolio. So looks like you bought 3 right off the bat here in May of 2021. And then you added your 4th here in February of 2022. It's great to see clients coming in and buying 3 right off the bat because that builds in consistency to the portfolio. What was it about it for you? Was that something you were excited about? Did you already know that 3 is sort of a magic number to get to? Or was there maybe some trepidation jumping in and buying 3? What was that for you?
No, 3 was, I bought off on the balance. I kind of knew it. When you have a turn, you'd like to have the other ones balance it out, was good. And then it was also, I know you got your 4 neighborhoods. I tried to spread it out and figure out which neighborhood was best. And again, kind of fit into the diversification thing. But it was one new one, couple of rehabs, it kind of balanced. And the last one was actually more diversification. It was in a kind of a B-class neighborhood, which was why it's a little higher, but kind of tried that out.
Yeah. Well, you got 3 of the 4 neighborhoods right there. You're only missing the south side. So maybe on your next one, you'll get a 32207. And 4 is a great number. 5 is a special number though, too. Has the team talked to you about JWB Elite?
I know that you save 1% on the property management costs.
Yeah. So when you get to 5 properties with JWB, you drop your monthly management fees from 10% per month of the rents that are collected down to 9%. And then as you get to 8, a total of 10 properties owned, we drop it again to 8%. So continual goal alignment there and increasing those cash flows and returns for you here. So now what we're going to do is we're going to look at your highest return on investment. This is straight off of your client ROI report, Kevin. So you're probably aware of this. But for those who haven't seen this before, this is that monthly reporting that Kevin and I nerd out on every single month. This return on investment that we're talking about here does not include home price appreciation. We'll save that for the very end here. But this is the property on 9th Avenue. And you can see here, we're beating our return expectations. You can see the annualized lifetime returns. And this doesn't include home price appreciation. We're at 16% when your expected returns were 9.5%. Kevin, was there anything about this property that jumped out to you right off the bat? And you said, hey, listen, I know this is going to be the winner out of the 4.
I forget the very specifics, but it would have been in the top in terms of IRR and the spreadsheet of the ones that, I don't know. I worked with Mike Stewart, and I think I got like 10 options, and this was in the high in the IRR area.
Perfect. And you bought 3 right off the bat, and this was one of those 3. Right. I can assure you, those 3 that you purchased right there, they all had roughly the same IRRs, right? And this kind of speaks to how we think about rental properties. Now, we love the asset class, but the properties more or less are widgetized, right? It's a production line. We follow the same system every single time so that we can achieve the same results. And then sometimes you're going to have this property on 9th, and that's going to be your winner. But Kevin, as we have you on the show, maybe in 5 years, it may not be the winner. Over time, they all perform the same way. And that's why we're all bought into the long term here. And then we're going to look on the other side, your lowest return on investment. This one on Sunrise Ridge, okay? We've got an expected annualized return just on the asset on the profit centers, not named home price appreciation, of about 10.5, 10.7, and we're at 6.6. Can you talk about your experience here with this property, which is the lowest returns?
I mean, there's nothing really been negative. They've had a couple of maintenance things, but nothing big. I think it really truly is. The other properties were bought a year earlier. I mean, it didn't get quite the ramp up. The first year is obviously the most expensive. And then I did purposely buy what's considered a B class property with the understanding of thinking that it might have less turns over the long term and a little less beating on it by a tenant, which, as I mentioned, in Kansas City, I had a little bit of trouble with. So that was the thinking. We'll find out if it was good thinking.
Well, it's interesting, because if we're doing our job as a provider, we should account for if there is an increased maintenance cost or a turn cost. We should account for that in the property evaluations. That is included in your IRR expectation. But if we just showed these 2 properties to somebody who didn't know the numbers behind it and said, which is more likely to have a better return on investment, I would think most people would look at this picture and they would say this one.
Yeah.
Right? Versus your property here on 9th, which is clearly a smaller home. And that's why we need to look beyond the pictures, beyond even the fact that it's new construction. And that's the value of having that, again, that data flywheel, the 17 years of real data that we can use to help and inform. And you're always going to have one that's doing better, and you're always going to have one that's doing worse. And what I tell people is it's very likely those 2 will switch the next time we get together and have you on the show. All right, Kevin, we're going to take a look at your portfolio overall here. So this is the full picture, and some of this you haven't seen before. Since you started to invest with us about 2 years ago now, we've been able to generate about $7,500 in net rental income. When we talk about cash flow, that's what we've been able to put into your pocket, especially in an environment like the last 2 years. If you think about where your money could have been where it could have been invested, very hard to imagine you would have earned this type of cash flow coming back to you, right? Stock market generally doesn't produce cash flow. Bonds, up until recently, coupons on bonds were so small. So you just weren't going to get that. So you're already winning with your decision to come to this asset class versus the more traditional alternatives. And we haven't even gotten to the other fun profit centers here, tax savings. All right. Kevin, can you talk about what tax savings means to you? Why you love it come tax time every single year?
As a traditional W-2 income earner, it is really nice to be able to see yourself make money, but the IRS see you as losing money, which is, I don't know, it's an amazing thing, but it's actually true all the way down to the tax, you put in there with the whole, depreciation numbers. So I love the fact that you almost look like it is the cash flow is almost tax-free cash flow. It's almost the way you think of a 401k, except you're able to take the money each year. But it's money you get that comes in, that sits on top of your W-2 income, but it doesn't get taxed because the IRS sees you as losing money against it.
That's such a beautiful comparison, comparing what you have created here, which is not in a retirement account, and comparing the benefits that we actually get in retirement accounts, which is not paying taxes on the income that we earn from those retirement account investments. You're able to sort of do that in rental properties, and it's because of this incredible write-off called depreciation from a tax perspective. So that's what we are quantifying here. This is $3,600 in taxes that Kevin did not have to pay, and he would have had to pay that if he earned that same amount of net rental income in some other investment like a bond or in the stock market. So it certainly helps. In about 2 years, he's paid down about $16,500 of principal pay down. This is your resident paying your loan down for you. So in addition to producing positive cash flow for you, they also pay down your debt for you, which is super, super powerful, especially as you hold on for a full market cycle. But then we get to the big one, especially over the last 2 years. You know, Kevin, you're like Pablo, right? You picked about the best time from an appreciation perspective to invest in rental properties. I've never seen home price appreciation like we have over the last 2 years. So congratulations for that. Your portfolio has appreciated to the tune of $210,000 over these 4 properties in just a 2-year span. How does that make you feel?
Fantastic. And I appreciate what you guys do to make it happen.
Well, it started because you chose to do something that most people just never do. Most people stick to the average way of investing. So it's a big credit to you. I also like to show I try to show to enjoy the positives of this, but as Pablo would tell you, I always try to, show the other side, which is we had a really great run up with home price appreciation, but over the long haul, home price appreciation works the same over 10 or 20 year cycles. And so while you got a huge head start with home price appreciation, still when you're doing your planning for what your assets are going to appreciate at over time, over a 10 or 20 year cycle, still keep those historical averages in mind. Over time, it's probably going to get to call it about 4.5% home price appreciation over the long haul. And that's just how these cycles work. So let's appreciate the positive. You started out with a huge head start, but for all of you who are thinking, oh, did I miss the boat? It's not real. Right? Over 10 or 20 year cycles, it all comes back to call it 4.5%, maybe 5% home price appreciation for the Jacksonville market. And then lastly here, inflation hedging and inflation profiting. We still have a big problem in this country with inflation. Our spending power as an economy is eroding to the tune of 6.4% right now, which is the latest inflation metric. That's the consumer price index. And so if you're thinking about where to put your money, you want to make sure that you beat that number. And inflation or real estate rental properties is a great hedge against inflation, like we've seen over the last 2 years and like we've seen over the last 40 years. And so that is a fifth profit center for you. Kevin, overall, when you put your money with JWB, your expected return on investment was 9.5%. Based on all 5 of these profit centers, your actual return on investment is over 28%. And so we have been able to beat your return expectations. Congratulations, my friend.
That's awesome. And I'd say actually one thing in the inflation hedging thing you didn't do. Last week you talked about, I think you said you had like 71 renewals.
Yes.
You guys were good to me. I was 2 of them.
No way.
And of the 2 that were renewed, I mean, I don't know percentage wise, but it was like 25% renewal on the, up on the rent. One of them was like $350 more a month in rent. And I don't even see that in here. So that's fantastic.
Man, that's incredible. I'm so glad you shared that. When we renew leases, other property management companies like to, how can I say this the right way? It's easier for a property management company to rent the property below market rent or renew the property below market rent. But ultimately, that just is an opportunity cost for you as an investor. And so when we renew your leases, we're taking you right up to market rent. And so that's really how you can win. And at the end of the day, if you have a better experience and a better home to rent for the resident than the alternatives out there, they should be happy to renew for market rent. So thanks for sharing that. And you're right. That's just going to continue to bump up those net rental income numbers for you going forward. And then lastly here, Kevin, have you seen this chart before?
Not related to my stuff, but I've seen it done. Yes.
Yeah. This is, I think, I try to help people think beyond cash flows. So when you were talking about moving beyond just a low priced market with better cash flows and seeing all 5 profit centers, this is what I think of and what I want others to think of. It's this pie chart. So at the end of you holding on to this asset for 10 or 20 years, you're going to look back and you're say, all right, well, I did really well in rental properties. How did I do it? And you start to break it down by profit center. And what we see over and over and over again on this show, and one reason I show this every time we get to have a client come on, is I break down their total return on investment by profit center. And what we always see is 60 to 80%, or even more in your case, of your overall return on investment is driven by one profit center, which is not cash flow. It's home price appreciation. And so I'm so glad that you independently saw the light, thinking beyond cash flow, and that helped you move to a growth market like Jacksonville. Because at the end of the day, if you choose a growth market, that can equate to hundreds of thousands of dollars of additional return on investment simply by being in a market that appreciates more than the alternatives. And that's what we see here. And the cool thing is that no matter if I choose a client who started investing in 2006 or 2010 or 2014 or 2021, the pies all look sort of similar, right, Pablo? They all kind of look like that big Pac-Man.
You call it a pie chart. I call it a Pac-Man chart when we're looking at this thing.
So Kevin, you're just doing a great job, my friend. Thank you for the trust that you put in our team, and we're happy to be beating your return on investment expectations. And we'll keep the seat warm for you when you want to come back, and we get to give you another update of how we're able to help you.
Yeah, no, thank you. I appreciate all you've done, and I appreciate you inviting me to the show and showing me the appreciation numbers. I hadn't seen those, so it's nice stuff.